My mission on this podcast is to empower and inspire you in all aspects of life, whether that be from unlocking financial freedom to embracing personal growth. I'm Nikita Burdick, your host, and a licensed lender and attorney, and a dedicated mom to my two amazing sons, Connor and Colton. So join me as we hear from professionals that have reached extraordinary levels of success. And just remember, when in doubt, ask Mama, the mortgage mama. I'm very excited today to introduce Scott Rutherford, and he's with Elevated Capital Advisors, and he specializes in a lot of different investment tactics, 1031 exchanges being one of them. But I want to turn it over to him and tell us a little bit about what you do.
Yes, so I'm president at Elevated Capital Advisors and Elevated 1031 Exchange. I'm a licensed real estate investment consultant, 1031 exchange consultant, real estate agent with Equity Summit Group, and so forth. In addition to the consulting services that we offer at Elevated Capital Advisors, we provide access to streamlined 1031 exchange accommodation services through our website at elevated1031exchange.com. Obviously, one of the things to be clear on is I'm not an attorney, I'm not a CPA, so I don't do tax and legal advice. I simply have 20 years of experience working with 1031 exchangers and consulting with them on replacement properties and meeting all the IRS guidelines and so forth.
Okay, so kind of maybe can you explain what a 1031 is and kind of what your company does in the process?
Yeah, so a 1031 exchange is the swap of one real estate investment property for another while deferring the capital gains taxes. So 1031 comes from the IRS code, IRC code section 1031. So that's why it's called a 1031 exchange. And that's simply you could call it an IRS loophole. It's an IRS benefit where when you sell a real estate investment property, if you go through the proper process, you can defer the capital gains, you can defer depreciation recapture taxes and things like that. So there's some great tax benefits to doing so.
Definitely. And when you say you provide a streamlined process, what is that?
Yeah, so on one side, on the consulting side, we assist with the identification of replacement properties. We have access to a variety of types of investment properties that are available for the 1031 exchange replacement side of things. And then on the actual accommodation side, we've partnered with one of our web partners, Plenty Financial, who runs the back-end system and paperwork and so forth for the actual 1031 accommodation. So they handle the funds, the paperwork, the documentation, and whatnot to make sure that the 1031 exchange is going to be valid with the IRS.
Okay, so your company goes through all of that different steps for them. Does that work kind of like an intermediary? I know that's kind of needed in the process.
Yeah, so that's what the Elevated 1031 exchange side of things, that portal actually allows them to go in and open up their 1031 exchange account and create, like kind of begin that process of, okay, I'm going to sell an investment property. I have to have this 1031 accommodator in place beforehand. And so they can actually go in, open that account, create that profile and so forth, identify the property that they're going to be selling, and kind of get that process going. One of the most important things in a 1031 exchange is that accommodator needs to be set up before you close on the sale of your property. If it's not set up beforehand, the moment the title company closes and they write that check to you for your proceeds from that sale, those taxes are due. You can no longer do a 1031 exchange. So it's critically important to have that accommodation service set up before you close.
Okay, wow. So that brings up a lot of good points. So how does a 1031 start? So if someone knows they want to sell their home and eventually buy another property, they should retain your services first. And what goes from there?
Yeah, so from there, when the sale closes, the title company will actually send the proceeds from that sale to the accommodator. The accommodator holds those funds in typically a segregated account, just to make sure it's FDIC insured and so forth. they'll hold those funds on behalf of the investor. So that way the investor never actually touches the funds, because the second you touch those funds, those taxes are due.
Yeah.
And so that's step one, is making sure that that's set up ahead of time so that the wire from title at closing goes to the accommodator. From there, the accommodator kind of manages the timing process. You have 45 days to identify a list of potential replacement properties, and you have a total of 180 days to close on one or more of those replacement properties. And so the accommodator kind of manages that time frame, sends out the reminders, hey, this is how much time you have left to identify, this is how much time you have left to close. And then they also handle the exchange paperwork. So that's the paperwork that's going to have the list of the identified properties. It's going to have the identification of the properties that are actually being closed on, property or properties. So they'll sign all the paperwork with the title company and so forth. There's an assignment. So basically when the investor goes under contract for the replacement property, they're going to sign that contract, but the contract is going to be assigned to the accommodator. Okay. And so the accommodator is then going to close on their behalf, but so both the buyer and the accommodator are going to sign all the paperwork.
And so your company serves as the accommodator. Am I connecting that correctly?
So not directly. So that's our partnership with Plenty Financial. They do the accommodation portion as far as holding the funds and processing the paperwork on our behalf. So we facilitate that process along with our primary role, which is to assist in the identification of potential replacement properties.
Okay. So when you say identification of potential properties, do you already have like an ongoing list going? Do you help people maybe identify properties even before they sell? What's kind of your tactic there?
Yeah, so we work primarily with really our goal is to level the playing field by providing properties that traditionally wouldn't be available for most real estate investors. So we work a lot with properties that are under a tenancy in common structure. We also have access to DSTs, Delaware Statutory Trusts, and oil and gas royalties, syndicated multifamily deals, and so forth. So there are a lot of options out there that are not your straightforward 1031 exchange, where you just sell a rental property and then go buy another rental property. We don't particularly get involved with those because those are really straightforward, and your traditional residential real estate agent can help with that. And we're more about leveling the playing field so that those who aren't aware can become aware of more of the options that are available for a 1031 exchange. When they say like kind, so in a 1031 exchange, it's the sale of real estate and the purchase of a like kind asset. Mm-hmm. Real estate is awesome because when they say like kind simply means investment real estate. So you can sell a rental property and you can invest in a commercial property, or you can sell a multifamily property and you can buy oil and gas royalties. You can sell a DST, investment in a DST, and buy a multifamily property. And so really what we focus on are properties where, as opposed to having to go out and come up with millions of dollars to close on a high-end property like a single tenant triple net lease commercial property, or a big 250 unit apartment complex or something like that, where you'd have to come up with millions of dollars, we've actually partnered with the sellers of these properties who have structured them such that you can buy a percentage ownership in one of those assets. Thus, if you sell a $400,000 rental property, you could go into a $10 million, let's say an ambulatory surgical center or something like that, and just own a deeded ownership percentage in that property and take advantage of all the benefits of having a long-term corporate guaranteed lease, triple net, where the tenant is taking care of the property taxes and insurance and maintenance and repairs and so forth. So it gives you the ability to get into a very passive investment where it's managed by a professional property management company, where the tenant is taking care of most of the responsibilities on the property. So those of us who don't have, $5 or $10 or $20 million to go out and buy a big surgery center, for example, or a Family Dollar or a Dollar General or something like that, can get into that quality of asset without breaking the bank. And so
Right.
it's, like I said, we're really about leveling the playing field and helping people understand the flexibility in a 1031 exchange. People think of a 1031 exchange and they think there's all these rules and guidelines that I have to adhere to, and if I mess it up, the IRS is going to come after me. There are those risks, and that's why you really need to be working with a professional who understands all of that. But at the same time, there's this broad range of flexibility that most people aren't aware of, as far as the quality of assets that they can get into. I mean, you could sell $1 million property and spread that across a percentage interest in 4 different properties for $250,000 each and create a portfolio. So there's, like I said, we're really about strategizing and coming up with the best long-term plan for the investor, and getting them into a higher quality asset than they'd be able to get on their own.
Yeah, I like that idea. And when you're saying your divisible share, you're talking about the tenants in common where you own a certain percentage of that property outright, not like you're sharing it under a joint tenancy type of situation.
Right. That's one thing I love about tenancy in common is, I mean, it's a structure that a lot of people aren't familiar with, but it's
Mm-hmm.
actually been around for over 700 years. I mean,
Mm-hmm.
this is not a new ownership structure. It's a long time proven ownership strategy that simply facilitates the ability for investors to buy an individually deeded interest in a property where they control their specific interest in the property without being partnered with the other co-owners. There's no tax, partnership as far as taxes go or anything like that. And they can kind of control how long they want to hold that asset. Let's say something comes up and maybe they need access to some of the funds that they had invested in that property. They could sell their interest in the property, or they could even sell a portion of their interest in the property.
Mm-hmm.
So to give you an example, let's say someone did a 1031 exchange and put $500,000 into an urgent care center. And then a year later, another opportunity comes up and they need $100,000 to invest in this other opportunity. They could actually sell $100,000 worth of their ownership in that property, leave the other 400 in, do a 1031 exchange with that 100,000 and invest, purchase the other investment property. And so, like I said, we're really about educating investors as well as real estate agents on the flexibility that there is there and the opportunities there are to kind of upgrade your portfolio.
Yeah. So, and when someone's looking to sell some of their property and they have this money to invest in a tenants in common share of, say, a big surgical center or an urgent care, do you have like a list of properties where people are selling certain divisible shares? Because the whole thing isn't usually selling. Is that right?
Right. So usually the way they're structured is the seller of the property is usually what they refer to a lot of times as the sponsor. And so they've actually acquired the property, structured it for co-ownership,
Mm-hmm.
and then they'll sell interests in the property over time. When someone when someone goes to sell their interest in the property, there's a variety of ways they can do that. They could technically go out and list that with any real estate broker.
Mm-hmm.
They could sell that directly for sale by owner, or they could actually list that back with the sponsor and have the sponsor add that to kind of include that with their inventory of available properties. And so then when people are contacting them, they can then send out information on that asset being available as well, even though they're not technically the seller of it, but they can still facilitate that information. Or sometimes even the property management company can do that and just notify potential buyers that the property is available. One other cool thing is that the co-owners on the property actually have a 15-day first right of offer.
Oh,
And
wow.
so when someone is interested in selling, let's say you're one of the co-owners on this property and you really like how the property is performing and so forth, and one of the other co-owners is going to sell all or some of their interest in the property, the property management company will actually send a notice out to all of the co-owners letting you know that this party's interested in selling, and you have 15 days to submit an offer to buy that from them, so then you could actually increase your ownership percentage of the property if you wanted to.
Okay. And so when someone owns, say, 15% share of a property, how does it look for, payouts, proceeds, return on investment? Is it like they get a percentage of the rental income? What does it look like for an investor?
Yeah, so they get a percentage of the rental income, and so traditionally most of these are going to pay rent monthly, and so the rent comes into the what we refer to as the lease administrator, or otherwise known as a property management company. The lease administrator receives the rent. They'll then disperse that to all of the co-owners based on their precise ownership percentage. those deeds are typically recorded to the 10,000th of a percent, which makes them very specific and very accurate. One of the reasons that's so cool as far as 1031 exchanges and self-directed IRAs and cash investments and so forth go is that it gives the investors the ability to invest exactly what they have, exactly what they need to invest to meet that requirement. So for example, in a 1031 exchange, if I have $187,242.16 in my 1031 exchange, I can actually invest that exact amount into a tenancy in common investment.
Wow.
And my deed will be recorded to the 10,000th of a percent. And so then each month when the property management company processes that rent disbursement, they're going to multiply the rent that came in by my ownership percentage of the property, and they're going to disperse that by direct deposit. So again, very passive. They don't really have to think about it each month. It just kind of shows up in their checking account.
That's awesome. And if I'm a potential investor looking at potentially doing this, are there does your company provide, or do you work with agents that provide what kind of return this particular project might be doing, like say 6%, 7%, 8%? Do you have like a portfolio, or how does that process work?
Yeah, so we work with the sellers or sponsors, like I said, is another word for them, of the properties. And so we'll have information on the rates of return. We'll have due diligence that we can provide. We'll have an offering memorandum that kind of summarizes the deal, what the rate of return is, what the rents are. If there are any rent escalations, most of these properties are going to have rent escalations built into the lease. And so we'll provide all of that information. The great thing is for agents is we actually pass through the entire 3% commission to the agents. And so they get the full traditional 3% commission on that. It's the same as if they went directly to that sponsor and signed up with them to refer business over, they would get 3%. They have the advantage of working with us. We have more experience in this industry than anyone else in the industry. So they have, advantage of our 20 years of experience of doing this. And my theory around working with real estate agents is to play to their strengths. And so if it's an agent who is new to this arena and really just wants to make an introduction and kind of be a fly on the wall and have us handle the kind of providing the information and going through the process with the buyer and so forth, and really kind of even all the way up to closing the deal and so forth, we'll do that. And it doesn't change what that commission amount is. Or if it's an agent that's very protective of their contacts and they're like, look, I want to hold this client's hand all the way through the process. I'm going to be the point of contact. We can just be in the background feeding information over. They can run lead and take care of the client, and it's not going to change anything. They're still going to get the full commission.
So an agent that has a client that's selling property and needs to buy shares or invest in some of these other 1031s, they just have to refer that client over to you, and then they receive the full commission?
Correct. Yep,
Awesome.
And they can be as involved or uninvolved in the process as they choose.
And does this apply for real estate agents in any state? I think you're in Utah, is that right?
Yeah, so we're based in Utah. The great thing is because it's a broker referral agreement, it crosses state lines, and so they can just sign the broker referral agreement, and if they forwarded the client over, they would still get the full commission.
Okay. And so you mentioned some other tactics like gas royalties and DST or GST that I wrote down. Can you go into some of those?
Yeah, so some of the other options, oil and gas royalties are an investment. It's considered real property. So oil and gas royalties are simply an investment of ownership in the royalties that are being paid on oil and gas exploration. So you're not investing in the exploration itself. You're actually buying a deeded asset in the benefit of that exploration. So in the actual production. And so oil and gas royalties are a deeded asset, and so it qualifies for a 1031 exchange as real estate, which is really cool. Most people don't know that.
No, I didn't know that.
Yeah. DSTs, Delaware Statutory Trust, is very similar to tenancy in common in that it is a percentage ownership in typically a specific property, or sometimes it's a portfolio of properties. It's structured a little differently because there's no direct ownership in the property. With a DST, they're actually buying an interest in the trust, and the trust owns the property. So there's a group of owners All of the investors own that trust together. So where with a tenancy in common investment, because it's all individually deeded, everyone would receive a 1099 at the end of the year. With a DST, it'll be more like receiving a K1 at the end of the year because it's more like a partnership. It's not technically defined as a partnership, but it functions a lot more like a partnership because they're buying an interest in the trust and not a deeded interest in the property. So slightly different, but it is flexible similarly where you can just buy a specific ownership interest in the asset.
And the trust owns a portfolio of properties. Did I understand that right?
Yeah, it can be either way. So it could be a Delaware statutory trust that just owns a single property.
Okay.
They could buy an interest in that, and it's just an interest in that property. Or the trust could own a portfolio of properties, kind of like a REIT, a real estate investment trust, except that when the DST is structured, it is a specific portfolio of properties. So if it's a portfolio, that portfolio is predetermined and it doesn't change. Where with a REIT, you're investing in it, it's more like a fund, and properties can kind of come in and out of that investment trust, and that's the reason that one's more. It's more of a true security and doesn't qualify for a 1031 exchange because you're not buying an interest in a specific asset or a specific set of assets.
Okay.
It's kind of a rotating set. Where with a DST, it's predetermined.
And when you have clients that you're working with and you're trying to figure out what they should invest their, say, 400,000 and 10 cents into, what kind of determines what ideas you're giving them? Like if you're giving them the tenants in common, the trust, the REIT, or what type of options?
It really depends on what their preferences are. Like how much control do they want to have over their ownership? That's a big one. A lot of investors really want to have some degree of control over their investment, and so they'll opt for something like oil and gas, where they can sell it whenever they want, or like the tenancy in common, which they can also sell whenever they want. With a DST, it's more it's being controlled by the trustee. So there's actually a designated person or group who is controlling that asset. When is it going to be sold? What are the market conditions? And kind of making all of those decisions. And so the owners really have no say at all. Where some people are more like me and they like to have some say in what's going to happen and when they get to sell and when they don't get to sell, and if it's going to be sold for above market value or below market value. They like to kind of at least get to vote on those decisions as opposed to just being at the mercy of a decision maker. So that's kind of one of the biggest differences. But yeah, our philosophy is to interview the investor, get to know them a little bit. What are their priorities? What are the benefits that they're looking at getting out of this investment? It's really kind of feeling it out with them and seeing what their goals are, because we prefer to structure something that's going to meet their goals. We want them to feel good going into the investment and feeling comfortable with that path forward. What's it going to look like over time?
I think it's really important to interview people and see where they're at, because if you ask me, I'm a lot different than my husband. If you ask my husband, he just says, I want to write a check and I don't want to be involved. Me, being an attorney for a while, it kind of puts me in a situation where I'm very slow to trust.
Yeah.
So what is kind of a minimum investment? Or first, let me ask you a first question is, what about people not doing a 1031 and they just want to invest money in some of these different tactics you have? Do you do that too?
We do, yeah. So the reason we focus so much on 1031 exchanges is because they have a very predetermined amount, and the flexibility that these investments offer is a great match for that. But any cash investor can invest in any of these assets. There's no requirement that it be a 1031 exchange. It's interesting because I've heard people say, oh, when I go invest in this 1031 exchange, you're not investing in the 1031 exchange. The exchange is the process. You're investing in a real estate asset, an actual property. So yeah, it's really about just kind of.
Yeah. Okay. And so what would be like a minimum investment amount that you would take up for a client?
Yeah, so it really depends on the specific property and the deal structure. So typically DSTs, a lot of DSTs will actually have a lower minimum investment than the tenancy in common investments. And then a lot of the investments like oil and gas and so forth may not have any minimum at all. Obviously, there's closing costs involved. So despite not having a minimum, most people would look at it and say, well, if I'm going to have to pay $2,000 in closing costs, I probably don't want to invest $10,000. That wouldn't make a whole lot of sense.
Right.
But if you're investing $100,000 or more, then it kind of makes sense. And so our recommendation on the tenancy in common side is to kind of always target something over $100,000,
Okay.
just because at that point, usually the sponsor will actually pay all of the closing costs, or at least most of the closing costs and title insurance and so forth. So they might have like a flat $800 buyer side closing cost or something. So it's more cost effective. Whereas if it's not over that threshold, then sometimes they'll have to actually pay for the title insurance policy themselves, because otherwise it's cutting into the seller's profit. And they're like, well, there's minimums on title insurance policy. And if I have to pay that minimum, even if you're only investing $25,000, I'm going to lose money on this deal. And so they kind of have their reasons for why they recommend going with something more than 100,000. But on most of them, it's quite flexible. Syndicated multifamily deals is another one that's just awesome. There's huge returns there. Those a lot of times, a lot of those will actually be structured where it's a hybrid investment where cash investors can go in as limited partners in the actual partnership, the LLC that owns the property, and then they'll actually have a portion of the property that's designated for 1031 exchangers, where they're actually buying a directly deeded percentage of the property separate from that LLC. So it's kind of a cool hybrid where it's almost like the best of both worlds, where they have the ability to either invest cash and be part of that partnership, that LLC that owns the property and those benefits there, or they can invest from a 1031 exchange standpoint and just get an individually deeded portion of that property. And so there's really some unique things going on right now with facilitating being able to do that 1031 exchange or cash or both. And then the other big one is self-directed IRAs and self-directed 401ks. That's a big portion as well. A lot of people don't realize if they have, $50 or $100,000 or whatever the amount happens to be, sitting in a self-directed IRA, or even in an account that they want to roll over to a self-directed IRA, they can now buy real estate in their IRA and have that cash flow coming in. The cash flow can either go into the, back into the IRA account and build up, and then they can invest in more. I mean, there's lots of really good reasons to do that with a self-directed IRA or 401k as well. Another really cool one is for people who are retired and they're having to take mandatory distributions from their IRA. So if they do that rollover, they invest in real estate, that real estate now has cash flow coming in. Rather than drawing down their IRA, they can actually have the cash flow be what's coming out to them. That oftentimes, if we structure it, we run the calculations ahead of time, figure out how much they would need to invest so that then those cash flows coming to them become their mandatory distributions, and they're not diminishing what they have in their IRA because that's now secured by a piece of real estate. So there's really, really good reasons to do that as well.
So on that note, I want to go back to some of the other ones too, but on that one first, is the tax consequences the same when you're taking, a profit from the real estate invested and using that as your RMD?
So it's really going to depend on the individual's tax profile. And again, I'm not an accountant, so we typically say, hey, like here's the way it works, and then talk to your accountant and see what the best way is to structure it. Typically, again, where if they were going to take those distributions and they're not a part of the mandatory distributions that are required based on their age, then yes, they're actually going to be paying taxes on that. It's going to be probably penalized because they're going to be taking cash flow out of an IRA when they're still underage. So they're going to pay penalties as well as the regular income tax on it. So that's something I would not recommend unless they have like deferred losses or something like that can offset the taxes. Then that's totally fine. I mean, again, so it's really like we try to look at it on an individual basis. What's their profile look like? There are even situations where sometimes someone looking at doing a 1031 exchange may not need to do a 1031 exchange. So maybe if they didn't do the exchange, their tax consequence would be $50,000, but they have $100,000 in deferred losses, well, then it's just going to go against their deferred losses and they're not going to pay taxes anyway. And so it's really about like talking individually with the investor, what's their situation and what's the best structure for that 1031 exchange or self-directed IRA, whatever it happens to be.
Okay. Yeah, and when I was doing estate planning full time, I got asked about these self-directed 401k and IRAs all the time because people always assumed as an attorney I do everything, so I know how to set these up. I do not. Do you set these up, or do you have someone set them up first and then you just help them purchase the real estate within the account?
Yeah, so we have, we don't do the setup on them. We have, if they have someone who they use, that's great. They can use anyone they want. They can go research and decide who they want to use. Or if they're like, hey, I'm new to this, I don't know who to use, we'll usually send them a list of several IRA custodians who will set that up for them. We don't do the setup. We just help with the real estate investment portion of it and all the paperwork going through to make the investment.
Okay. And you could still buy all the different types we've talked about today through a self-directed IRA or 401k?
Yeah, it's really cool.
That's cool. Yeah, that's awesome.
It has a great degree of flexibility. People don't realize how much flexibility there is inside those self-directed IRAs.
Yeah, I didn't know. I mean, I think we just have ours sitting in an account. So, I mean,
yeah,
it's
a lot of times it's sitting
but...
in an account or a money market account, like earning virtually no interest, and or it's invested. A lot of times people also, they're heavily invested in stocks, and then separately they have their real estate, and they don't realize that they could take a portion of what they have invested in stocks, roll that over inside their IRA, or roll it over to a self-directed IRA and invest in real estate that way and kind of add some diversity to their portfolio.
Yeah, that's awesome. I don't think most people know that. That did lead me into a question I was going to ask at some point, and that is, what are the typical or standard, if there is one, or average rate of return on some of these different types of investments?
Yeah, so it's really going to depend on the type of investment. So let's talk. So on tenancy in common, for example, in triple net lease properties, most of those are going to be in the 5 to 6.5% range starting out. That's usually not going to include the rent escalations. So once you average those in, then you're going to be a little higher, typically above 6%, sometimes even over 7% over time, based on those rent escalations and the length of the lease. So, for example, if you have a property that starts out at 6% or 5.75% and has a 20-year initial lease term and it has 2% annual rent escalations, over time, as that builds up, it's going to average over 7% by the end of the 20-year lease term. So depending on how long you hold on to that asset will determine kind of what your average rate of return is over time. DSTs typically are going to be very similar to those rates of return, sometimes a little bit lower because they're a little more heavily loaded on the fee side. Because they're a security, they're very expensive to structure, and so the fees are significantly higher. The sponsor is going to take a larger portion of that to cover all of their fees and commissions to the securities brokers and so forth. So those are usually going to have, just again, depends on the specific property, but a lot of times they'll have a slightly lower rate of return. The syndicated properties, like the syndicated multifamily deals, those are structured quite a bit differently because they'll usually provide a fairly low cash flow initially, and then that cash flow will ramp up over 3 to 5 years. And at the end of the 3 to 5 years, they'll sell the asset or refinance the asset, one or the other. And the rates of return at that point are pretty astronomical. A lot of those are doing 200 to 300% cash on cash, or not cash on cash, but return on equity. So, you put 100,000 in, and when it sells in 3 to 5 years, you get 200 to 300,000 out. And most people obviously then just turn around and put it right back into another one, because that's a really good way to, if you're early in your investment cycle, it's a great way to grow that nest egg. It's a little higher risk, but the reward is significantly higher. So it's a great way to grow your nest egg, as opposed to, the flip side, where if you're working with someone who's retired and they're really just looking for stable cash flow, then things like a DST or TIC is going to be a lot more attractive.
More conservative.
Oil and gas has averaged higher than real estate over the years. Obviously, it's a lot more volatile because what you're getting is the cash flow from whatever it sold at that month. So every month you could have 1 month where you get nothing. You could have another month where you get this massive payout, and it's all because it's subject to those, the oil and gas prices. And so it's a lot. You have to be someone who's really flexible and isn't relying on that monthly cash flow to go into it.
Right.
But if you're not relying on that monthly cash flow and you're just looking at your overall rate of return, it's a really good investment because, again, over the years, it averages higher than the real estate industry.
That's awesome. I can see where you would need to make sure you know what your client is looking for.
Yeah, for sure. And a great approach, obviously, is to diversify, spread it across multiple asset types. And yeah.
Especially young investors who don't need, access to all their money all the time.
For sure.
So you brought up syndicates a lot, and I just wanted to, just in case people don't know what a syndicate is, can you kind of explain what a syndicate is?
So a syndicated property is, in certain ways, is similar to a tenancy in common or a DST in that it's a group of investors who's acquiring an asset or acquiring a property. And so you'll usually have the general partners, otherwise known as the sponsors. The general partners in the deal will actually go find the property, put it under contract, get the financing approved from the bank, kind of get the whole deal structured, and then they'll go out and typically through a private placement memorandum or something along those lines, they will raise money through accredited investors who can then come in and invest in that property, or basically, as I mentioned before, they're actually investing in the LLC that owns the property. And so it's structured more like a partnership. The LLC, so the general partners are going to form this LLC. The LLC will provide that the limited partners, the investors who come in, would then own a percentage of that LLC based on the amount that they invest. And they're going to get that percentage of the monthly cash flows, and they're going to get that percentage of the payout once the property pays out, and so forth. And then, as I mentioned, there in recent years has been an approach of doing that combined with tenancy in common and allocating a portion of the property as tenancy in common, because the syndication itself does not qualify for a 1031 exchange, because you're not investing you're not buying a deeded interest in the property, you're buying an interest in the LLC, right? So that's why it doesn't qualify for a 1031 exchange. So they'll actually structure it so that they can accommodate both 1031 and non-1031 money by having the syndication portion, that LLC, structured for cash investors and self-directed IRAs and so forth, and then a portion that's allocated as tenancy in common so that 1031 exchangers can go in and still buy an interest in that property as well.
Okay. And so when you say you're buying an interest in the LLC, you're likely just buying an economic interest with no, voting or managing powers.
Correct. Yeah, the general partners make all decisions on it. The limited partners are simply silent investors.
Okay. And I know I've been asked to do a syndicate before, and when we looked at it, it's like you have a minimum amount of time you can't get your money back out. Is that correct?
Usually? Yeah, usually that's correct. And again, it's going to depend on the specific structure. So usually there's going to be a minimum of time that you can't get your money out. And sometimes they'll even restrict it to where it's like you're in the deal until it sells, and it's going to sell in 3 to 5 years. And the general partners, much like a DST, the general partners are going to be the ones who are going to make that decision as to when it's going to sell and how much it's going to sell for and whatnot. So yeah, it's really important in those to look at the projections, see what kind of due diligence the sponsor did going into it, make sure everything kind of aligns. As in any aspect of real estate, there are people out there who don't structure them properly, and people end up getting their hat handed to them afterwards, and it's not pretty. But fortunately, the folks that we work with haven't run into that. So.
Well, and I'm sure you do your due diligence looking into the different type of syndicates, because you're locating them. You're not starting. You're not a general partner of them, or are you?
We can be, but typically no. So typically we have contacts and we'll be involved in some form. And so that may be as a general partner or may not be as a general partner. But yeah, just kind of, again, depends on the specific deal if we're going to put money into it or not.
Okay. And I know you went over like typical minimums for different type of investments, but just for, potentially anyone listening that's very interested in this, what is the minimum amount you would require for an investor who's not doing a 1031 to invest with you?
Um, so really, because there are a variety of products we can help them into, there's not technically a minimum. I would still say it would be difficult to get into something for less than $25,000 and still have it make financial sense once closing costs and so forth are paid. So I would say anyone with over $25,000 that they're looking to invest, reach out to us. Let's talk about it. Let's see what you're trying to accomplish. And if there's something that aligns well, then let's take a close look at that. And again, it's going to depend because some of the types of assets like oil and gas and tenancy in common don't require you to be an accredited investor, whereas things like DSTs and usually the syndications will usually require that you're accredited, meaning that you have, over 250,000 in annual income or over $1 million in assets.
Mm-hmm.
So, again, let's have them call us. We'll talk through it. We'll see what their position is and see what the best recommendation is that we can make for them. And, if it's not a good fit, we're just going to tell them it's not a good fit. That's the greatest thing is that we're just going to tell them straight up, this is what we recommend, take it or leave it, or, this probably isn't a good fit, or we recommend, sometimes we'll even send them somewhere else and say, look, this is probably your best fit. It's not something we do, but here's a phone number. Call this person and talk to them and see if they can help you out.
Right. And that's great. And so one of the things you mentioned was the syndicate will make sure someone's qualified, or they could make sure someone's qualified. What does that look like? You've mentioned a few requirements.
So that's the accreditation process. It depends again on the specific offering. A lot of offerings are they well, so there's kind of two different approaches to accreditation. Some will be where it's just stated accreditation, where basically you just have to fill out a form that says, are you an accredited investor, yes or no? And then it explains what that accreditation means. That you have over 250,000 a year in income, or that you have over $1 million in assets. So if you and you're just self-certifying is what they call it.
Okay.
So there's that approach, which basically just puts you on the hook. It's like if you lie about it, that's your problem, but don't lie about it, right? I mean, there's a reason they require it, and it's because it's not necessarily even that it's a higher risk investment. It's that it's a more complex investment, and they want people to, if they've got some experience and some assets, usually they've got, they're a little more educated as far as those types of investments go, to where they're going to be making an educated decision, and they're more prone to enjoying the experience and not freaking out about things. And if there's a hiccup one month and the rent comes a little bit late because some tenant paid a little bit late or whatever, right? So there's that process. The other process is a certified accreditation process, where they actually have to send a notice over to their accountant, and their accountant has to certify that they're an accredited investor.
Okay.
And so that's the other approach. Now, that said, most investments also will have a certain portion of the investors that don't have to be accredited, but they have to have a pre-existing relationship with the sponsor, or with one of the general partners in the deal. So, for example, if we were a general partner in a deal, and there were an investor that we had a relationship with, that we've been talking to them for 6 months or a year or whatever, and we've developed this relationship, and they're not accredited, but they say, look, I'm really interested in this syndicated multifamily space. I'd really be interested in investing there. As long as we've built that relationship and we're involved in that deal to the extent that we can introduce them to it and show it to them, then there's still the possibility that they could invest in those. So it's not this cut and dry thing. If you're not accredited, you can't invest. There's a little bit of gray area or a little bit of leeway in there for people with whom we have a well-established relationship.
Okay, got it. And I did have another question, is that do 1031 purchases get the same depreciation for tax benefits for write-offs?
Yes. So depreciation, that's another one of the great things. We'll go back to this on the tenancy in common side.
Hmm.
So let's talk about it from that standpoint. So on the tenancy in common side, and actually also on the syndicated side, they do still get depreciation. So obviously with depreciation, you're depreciating the improvements on the property, not the land. So the land
Okay.
is non-depreciable, the improvements are depreciable. And so yes, they can continue with that depreciation. So if they did a 1031 exchange, they probably have already started depreciating their original basis, their
Hmm.
original investment. So basically, when they go into the new investment, they just kind of pick up where they left off and
Got it.
continue their depreciation from there. If it's new investment capital, then they would just start fresh and start depreciating the improvements on the asset. Some properties, and particularly a lot of the syndicated multifamily deals, will actually do a cost segregation study where they'll have a third party come in and look at all the fixtures and everything on the property and find specific portions of that real property that would have an accelerated depreciation.
Okay.
And so there's some great tax benefits there too, because they could actually take more depreciation. They could actually, even though they're getting income from the property, they could take more depreciation than their income and actually show a loss every year, even though they're getting cash flow from the property. So there's some
Yeah.
really cool things that can be done with depreciation there. DSTs, I'm not going to say cut and dry, but I'm quite certain that DSTs do not offer depreciation because you're not investing in the property itself. You're just buying an interest in a trust.
Right. Okay.
I'm not going to say 100% for sure. I would have to double check on that. I would, but yeah, and it could vary from one to the other. But in my experience, they don't allow you to do the depreciation. And then obviously with things like oil and gas royalties, there is no depreciation because there's no assets. It's just an investment in the income.
Yeah, that makes sense. So you've mentioned how people with at least 25,000 can invest in you or invest with you, and then real estate agents could still get that 3% commission. So how are people reaching out to you? How do you want people to contact you?
So they can call. There's actually a variety of ways. Let's talk about a few of those. So first off, they can just call our office at area code 619-436-1031.
Okay,
So
1031. I like
619-436.
that.
Yep. Or they can call me directly on my cell phone, 801-949-1100. That's fine too. Email me at scott@elevatedcapitaladvisors.com. Or they can go to our website, elevatedcapitaladvisors.com, and just complete the contact form there. So those are great ways. Or look up Elevated 1031 on LinkedIn or Facebook or Instagram. We're on there.
Okay, perfect. Well, this has been so exciting, and I could probably keep going, but I want to be respectful of your time. And so, is there anything else you wanted to maybe say before we end the podcast? Something you want to put out there?
No, like I said, I mean, this has been really awesome. I really appreciate the opportunity, and really, we're all about education. So, if anyone's watching or listening and they have questions, just give us a call because I really love to educate people and kind of expand their knowledge base and give them the opportunity to learn more. I think, particularly with real estate agents and brokers, if you want us to do a course for your agents and teach them about 1031 exchanges and how they can kind of boost their business by understanding 1031 exchanges and these types of investments and so forth. It's really about providing a higher degree of professionalism and a higher degree of service to their clients. And so it's a great way to boost your business is the more you know, the more of an expert you are, the more those clients are going to trust you, refer you to others. So it really is an awesome way to kind of increase your business as an agent, as a broker. So reach out to us. We'll put together a class for you and teach all your agents how to do this.
You brought up a really great thing just now because just like you, agents are one of my top clients as well. So I would love to do a course with you and try to get a lot of agents to sign up, and maybe we can both get in front of them.
Yeah. Yeah, I would love to do that.
Okay, well, thank you so much for being on my podcast today. I had such a great conversation with you. If you guys like this content, please follow me, More Than Financing with Mortgage Mama. Thank you, and that's the end of our episode for today.